What's up, y'all? So today we are here again with another episode of Level Up with Living Houston. And with me today, I've got the host of the show, Laura Weisman, who is the owner and realtor of Living Houston. And in addition, we have a special guest today. We are going to have Dave Krichmar with DaveYourMortgageGuy.com. Dave is a mortgage banker, and he's going to tell us who he's with and a little bit more about his business. But for right now, Laura, how are you doing today?
I'm good.
Cool. So why don't you tell us what we're going to be discussing today, and then we'll dive right into it.
Today, what I want to bring to my viewers and to my clients and future customers, I, being in real estate for the past 6 years, of course, I've worked with a lot of buyers and I love working with buyers. However, I think just living in Houston in general, there are a ton of business owners or people that are self-employed. Not to mention, realtors are independent contractors and they're self-employed as well.
Yeah.
So with you and I both being entrepreneurs our entire life, even when we've owned lucrative businesses, it's always been hard to get approved to buy a home.
It's been a tall task.
Yes.
Absolutely.
And I have a lot of people that come to me or buyers that call saying they're looking to buy a home and they cannot get financed because they are technically self-employed, and there's so many obstacles that come along with being self-employed and trying to get a loan on a home.
So today we're talking about self-employment and what is needed if you are self-employed and you want to buy a house.
Correct.
Cool.
Yep.
And that's where Dave comes in.
Absolutely.
Dave, how you doing, brother?
I'm good, man. How are you guys?
Excellent. Appreciate you coming on the show today.
Yeah.
Cool. Well, let's go ahead and get started. Let's talk about it.
Okay. Well, what I really want to start with to begin with is kind of what's the definition of self-employed, because there's a couple different ways that can go. So how do you define that?
Absolutely. First off, I want to say thank you so much for having me.
Absolutely.
Right? I was super pumped to be here, and this is a big deal being on your podcast, so thank you so much for that.
You're welcome.
And before we dive into that, Dave, if you would, tell me a little bit about your history in the business so we can let people know who you work for, actually the company itself, the website, which I just mentioned, and a little bit of background, and then we'll dive right into what does it mean to be self-employed.
Absolutely. So my name's David Krichmar. I'm DaveYourMortgageGuy.com with Legend Home Lending. I'm a mortgage banker, and so what that means is I handle the entire process. You'll hear about brokers, and all they're doing is really collecting your information, sending it to another company, which is very risky. But I control all of it. I've been doing it since 2001, so I'm real old.
Oh, wow.
Yeah, super old.
You're experienced in the industry.
I'm experienced in the industry. Thank you. Yep, exactly.
Gotcha. All right, cool. Well, let's dive right in. So the question was, what does it mean to be self-employed?
Someone that owns their own company, they think, hey, I have no problem getting financed. I make all this money. And an underwriter looks at things and says, hold on a second.
Yeah, absolutely. That's a great point. So someone who's self-employed is someone who's self-employed, owns their own business. Under that also falls under someone who gets paid a 1099. So if you get paid a 1099, you're treated like a self-employed person. Mm-hmm. All right. The way underwriters look at income when you're self-employed for conventional FHA, VA loans is they're looking at your income after write-offs.
Right.
So a lot of us self-employed people look, well, hey, I make $300,000 a year, but I wrote off $250,000. Well, I make $300,000 a year. Well, that's not how an underwriter looks at it.
Right.
They're looking at your income at $50,000.
Right.
So that's the first thing to know going into is what you make and what you know you make, and what your CPA shows are always something different.
Yeah.
Right.
And I learned that the hard way.
Right. Yeah.
Absolutely.
All of us have.
I mean, as a business owner, you want to write off as much stuff as you possibly can, so that you pay minimal taxes on that.
Absolutely.
And then, when you go to get a house and you've only showed 40, 50 grand in income for the last 2 or 3 years.
So going back to tax returns, your CPA and all of that, okay, they're going to look at what the income is after write-offs.
Right.
Right. Now, one thing that they don't tell you, and this is a great nugget of information, is certain write-offs you can actually add back into the income. Okay. So if you have a lot of business miles, you can add that back in to the income. So if you're doing your tax returns and you're a landscaper, you travel, whatever it is, driving,
Right.
that's an amazing write-off to add back in.
Okay.
Because it's it's a win-win,
Right.
right? You're writing it off, saving the money,
Right.
adding it back in to qualify.
Right.
Okay.
So with discussing this, if someone comes to you and says, all right, we want to buy a home within the next 12 months or 2 years, and they show you their current or past recent tax returns, you're going to look at those and let them know what they need to, like, in order to position themselves so that they can buy in a year or two. You can kind of give them advice on what they need to be filing or claiming. Is that going to be something important?
Absolutely. So one thing I do with my clients, probably because I'm much more involved than most lenders, you're going to send them their tax returns and they're going to give you a yes or a no.
Right.
Right? Hey, you make enough. Hey, you don't make enough. You're denied. Right? I don't operate like that. I want to go above and beyond for the client. So if they can't get approved based on an income, we're either going to address what the income needs to be on the next tax returns.
Right.
Okay. And so what I'll do is I'll
That's what
say,
I'm referring to.
right, is if they want to buy a $300,000 home, how much money do they have to make?
Right.
And then we go backwards.
Or what do they have to show that they make, so to speak?
Right.
Okay.
Exactly. So we're going to start with what they want and then help kind of figure it out. Then we're going to have the CPA prepare it. I'm going to review it. And then they could go and file it.
Okay.
So that way it doesn't happen to them. You know, if they've been denied, they've been denied. If we know, like right now, we're filming this in August, a lot of self-employed people have exemption or an extension, right?
Right.
That's
Until
in October.
Yeah.
Till October. So now's a perfect time to sit there and go, hey, before I file 18, I wonder how much I have to make to get approved.
Right.
Right? And so I'll actually help the client. We'll go over that, have the CPA work them up before they file them,
Okay.
review everything, then they file it. Perfect. So anytime it happens around the beginning of the year, so before April,
Okay.
tax day, and even now before October, I have a lot of self-employed people where it's the perfect time to address all of this before you file.
Got it.
So going back to your question, you're 100% right. Not only am I going to help them do it, but it's also certain times of year where it's perfect.
Okay.
Right?
Right.
On a side note, and this is like one of those public service announcements, not every CPA is the same. You'd be amazed
Right.
how many
not
times.
Not every realtor is the same.
Not every realtor is the same. Not every lender. Not every landscaping guy. Not every doctor.
Right.
I've had so many examples where the CPA royally screws up filing because maybe it's more intricate than what they're used to. Like if you're self-employed, H&R Block's not your friend,
Right.
right?
Exactly.
Like you need a true professional CPA.
Right.
So don't assume that they're just going to do what they need to do,
Right.
and then you're
and
okay
then you
with
take
it.
their word for it and carry those tax returns to your lender, and then
Yeah.
Okay.
Yeah, I've had many bad experiences with accountants not filing properly, not filing on time, or not filing at all.
That last one, I have a client right now who's like, yeah, we filed. It's not on record with the IRS.
Right.
What do you mean? I was like, and then they talk to CPA.
Right.
Well, yeah, I thought you were going to file it.
Right.
What client files it? Like
Yeah.
you give it to the CPA,
What you
CPA,
pay
he
the
files.
CPA for.
Right.
Right.
Yeah.
So what do you think about this people that get paid commission? So realtors fall into that category. And then I've had a few other clients that they work for companies where they get paid commission, and some of them get paid large chunks of commission. So they make the great money, but it's being looked at as, 3 or 4 large chunks of income, and that kind of scares off the underwriter. Or
For most of those people, it's going to be a 1099 job. If you're commission in W-2, it's treated differently.
Okay.
If you're a 1099 commission,
Okay.
it's treated like self-employed.
Got it.
The lump sum money is not so much of a big deal as much as what you're filing. Now, most loans are going to take a 2-year average. So 17 and 18, 16 and 17, something like that.
Okay.
Sometimes you can do 1 year if you have a large down payment. There's kind of more involved in that.
Right.
But they're going to look at a 2-year average.
Okay.
But I will tell you something. This is definitely kind of inside information that not everybody knows because of what they're told from the lenders. This leads into a good topic, which is what about declining income,
Right.
right? What happens if 17 was great, 18 wasn't as good?
Right.
99.9% of lenders will tell you if the income decreased by over 25%, it's denied,
Okay.
right? I've
Yeah.
had
I've
friends.
seen it denied just off of a little bit of a decline.
Right, because the underwriter's fear is, oh my God, these people are going to make nothing in 2 years.
Right.
Which we
Well, and I
both know is
think
not the case.
one thing to point out that I didn't know about, and I think most people don't, is when you submit your records, your banking records, all your financial statements, they don't look at the summary sheet. They're going through every single charge, every income, every outcome. I've even found that, between my business account and personal accounts, instead of writing myself checks, I just transfer monies back and forth between the accounts. And a lot of those times as well is they don't actually count those transfers as income.
Right.
So if I transfer, for an easy number, $10 from my business account to my personal account, and I do that every single month, that is not considered $10 worth of income for the month or for the year.
Right.
So you have to actually handwrite checks and make sure you're doing it the right way for the lenders or the banks to accept it as a true income amount.
Mm-hmm.
Well, and that brings up a great point, and then I got to get back to the declining income point, but is if you own multiple businesses, right? So your main business makes $300,000 a year. That's fantastic. But a side business, you had write-offs, you're closing it, whatever it is, and it lost $100,000. Well, you can't only use one and ignore the other.
Correct.
The underwriters are going to take into account all of those.
Right.
So I've run examples where the main business is doing fantastic, but one big write-off for a business you were closing hinders it.
Sure.
Right. Or a business that's declining.
Right.
Going back to the declining income part. So many lenders are going to tell you if it declines by over 25% from the previous year, it's a denial, period. Cannot get done. That's actually not the rule. So the rule is it has to be explainable. So I have a guy right now, we're going to use a real world example. I have a client right now we have approved that was denied by 2 other lenders because his income was half of what it was in 17 versus what is in.
So is that considered a 50% decrease?
50% decrease. Yes, ma'am. So his income went down half, 50%. Other lenders denied it, too big of a decrease. The answer for why it decreased was he had bought a piece of equipment and wrote it off. Okay.
Wow. Okay.
Which is kind of a,
It's fair.
It's a fair write-off. It's not going to happen every year.
Right.
And he qualifies off of this lower number. So even in a worst case, he's still okay. My underwriter, because I have my own and knows the rules, was like, yeah, we're fine. Explain how this happened and we're good.
Right.
But every other lender right away without even diving into it goes,
right. They
denied.
won't touch it.
They won't touch it. It's denied. So if you're dealing with declining income, right, if you're right now dealing with that on the tax returns and you've been denied, that's a perfect example that's not the case.
Okay.
But you won't see that. You can Google it all day long. You can talk to 10 out of 10 lenders and they'll tell you, yeah, it can't get done.
Right.
But it's circumstantial if you're with the right lender.
Right, correct. And somebody who's going to put the work in it and the story, right? Like we had another example where it was a realtor. This was 2 years ago. She was pregnant the prior year, worked less.
Right, of course.
Right? Came back, still kicking butt, and was making the income. Well, they looked at it and said, no, like it's declining. They did not take a look at all at the situation. That was a fantastic example.
Right.
Yeah. So, I was pregnant. I didn't work for several months.
Right.
Well, she worked.
Yeah. You can't be a pregnant realtor and not work in this industry, right?
No, you're working in other ways as a mom. But sorry, I got to give a shout out to all the working moms out there.
Yeah, got to pull the mom card out there. Hey, y'all do more work than all of us. So
That's right. Yeah. So one of my other questions is, and I get this from a lot of people, is if they're a business owner. So if you're a business owner, you're considered a 1099 independent contractor?
Or you could be a 1099, you could be a Schedule C, you could file business returns where your K-1 income carries over to your personal, and then that's the income.
Okay.
You could pay yourself a W-2 and still do some of those other options.
Okay.
There's 7-8 different ways to do it, but I think maybe a better way to flip that is if you're not receiving payroll checks from a business, you're most likely going to be considered self-employed.
Correct. If it's not your business. Yeah.
Right.
Yeah.
So if you're a business, so I have a client right now that I'm dealing with this. He owns the business, makes very good money. He pays his W-2 employees, and they are able to use their W-2s to buy homes for their family, and he's frustrated because he's having a hard time getting financed.
Yeah.
So that's just, and to a lot of people, they're like, I don't understand why that is. I'm making enough money to pay employees and run this business, and yet I can't get financed.
Yeah, it's a very frustrating situation because any one of us in that spot knows that you're making the money.
Right.
right? It's more or less a ridiculous guideline. The truth of the matter is when you're self-employed, you right away have to talk to somebody who knows what they're doing and be upfront. Hey, if I can't get approved today, I want to know what it's going to take.
Right.
Versus a Quicken, Rocket Mortgage, Bank of America, they're just looking at what it is right now.
Right.
So if you're self-employed and you're automatically like, well, I'm going to go with Quicken, you're just asking.
And what's the difference? Like if someone submits their stuff to one of those big name companies, whoever receives that file and glances at it to say yes or no, are they more of like an hourly paid employee that's not personally invested in the outcome of the transaction?
There's a couple things that fall into that. One is that person's in Iowa in a cubicle, possibly, right? You don't know their background, how long they've been doing it. They're definitely less experienced. If they were more, they wouldn't be working there.
Got it.
They may not know the guidelines. They are getting a lot of phone calls. So their job isn't based on doing quality. It's based on doing quantity.
Right.
If they screw up the loan, who's going to yell at them? The client's in another state. If I screw up the loan, you're going to kill me.
Right.
Right? So
maybe just torture you a little bit.
Right. And never talk to me again. And so the quality is not that everybody knows what they're doing, right? That's assuming all realtors are the same. If it's all right with you guys, let me jump into some bullet points and kind of random thoughts I had that I see. One is amending tax returns. Okay. Most underwriters.
I'm going to go back and ask that as a question.
Yes, sir. Yeah.
Just for Q&A type purposes.
Yeah.
So tell me what's involved with amending tax returns so that you can get approved.
Yeah, no, that's awesome. The short answer is, again, most banks and underwriters do not want to do amended tax returns. Their thought process is right away you're amending them to qualify for the mortgage, right?
Sure.
Whether or not that's true or not, that's not the guideline, right?
Okay.
So you can go back and amend your tax return. So that's a situation where you could look at and go, okay, well, I had too many write-offs in 17. Could I amend them to qualify? Okay.
So in doing so, does that mean they're going to have to end up paying more taxes if they end up claiming more income?
They could, or depending on if the write-offs were switched around. Let's go back to the mileage, right? Mm-hmm. Maybe they reduce the write-offs of...
Yeah, they change out what gets considered income. So you
Right.
can add back in mileage.
The easy answer is yes. I mean, if you go amend your tax return and it shows more of a profit, then you're going to have to pony up and pay more taxes on that amount. Unless you're able to offset it with adding back to the form or the filing.
What's the technical name of adding back? Like when you say you can write off mileage and then add it back in as income, is there like a term for that?
Just write-offs, really. It just happens to be from a mortgage standpoint that you don't count that write-off as truly a write-off when qualifying the income.
Okay.
So the client...
It's more about the lender being willing to consider it as income.
Right. Reducing that write-off. Okay. So it's pretty much adding that write-off back in from an income qualifying because they know, in theory, mileage is kind of
right.
Made up, not specifically,
So you guys might look at a tax return and say, okay, they've written off 50 grand, but I can see here if we add back in $5 grand worth of the mileage, then it's going to help us out.
Yep, absolutely. Okay. Yeah.
Got it.
And I've seen it with if you write off a vehicle, if you go buy a $50,000 truck, they'll add up to a certain dollar amount back into the amount showing it as income.
Right.
I think it was like 20 grand, but I don't want to quote it because I don't remember exactly.
Yeah, no, that's a great point too. All right, so jumping into another one. These are all random things I see daily, right? That I want to go over. So a fear is I owe the IRS. I owe the IRS. I cannot buy a house. Okay,
right.
That's not the case. Okay, if you have a IRS tax lien, yes, that has to be paid. Okay. But if you owe, we're in 18, let's say you still owe for 17 and you're making payments, okay? Mm-hmm. That's no problem. We just have to document how much the payment is and add it into your bills. But a lot of people say...
And it gets factored into your debt to income.
It gets factored into your debt to income. Yes, ma'am. Okay. So right away, the fear is, oh my God, I still owe the IRS for last year.
I hear it all the time. I hear people say, I can't buy a house right now. We owe taxes.
Right. And that's not the case. And I've actually had situations where we did up to 2 years of owed back taxes. Mm-hmm. So you owe for 17, you owe for 18. You can afford the payment and the payment plan.
Right.
We're good.
Okay.
So that's a fear that the self-employed client doesn't know and assumes because the IRS is a serious thing.
Yeah.
Right.
It's scary.
it's scary. I owe the IRS. There's no way I'm going to be able to buy a house.
Right.
It's not the case.
Yeah.
Right. So
Well,
that's
and
not
when you
good.
do owe the IRS, whether it goes back in the last 2 years that y'all are considering it income or it goes back 5 or 6 years ago, I mean, you can going back many years, you can get on different plans, payment plans with the IRS. And once you're on those plans and you're making your payment, then you're good to go. They don't drop the liens, but it comes off your record so that you can buy an actual house. Y'all just consider whatever that monthly amount is into the DTI or debt to income as another payment.
Well, and going back to the lien, a lot of times it doesn't even become a lien until it's multiple years, right?
Right.
So most examples, getting away from the lien, let's just say if you do have a lien outstanding and there isn't really much of a plan, maybe you have to pay that. But just a lot of them I see owe for the last year or two. Mm-hmm. And then in their mind, they're like, okay, well, I owe 30 grand in back IRS, taxes.
Yeah.
And then I need how much for my down payment? Man, I don't know if we have that much money, but you don't.
That 30 grand they owe the IRS can be, they're get on a payment plan. So
Yeah.
they're not coming out of pocket a lump sum.
It's called an installment agreement or something, but you get on that agreement, you make the payments, and then you don't owe that whole amount or you don't have to pay it off before you buy the house. Y'all just take that monthly payment and consider it into their debt to income ratio to make sure that they can pay their monthly mortgage rate.
Right. Does that person make enough to pay this IRS, amount back over time? They do? Perfect.
Right.
We don't care. Let's get you in the house, right?
Yeah. They can pay their monthly mortgage payment, so we don't care about the tax deal.
Right. Because the chances are it's not going to become a lien because obviously they're affording the payment.
Right.
So that one's a huge one that, so many times if a self-employed client doesn't know, we all jump to the conclusion of the worst case scenario.
Right.
Right.
So it's impossible.
It's impossible. I owe the IRS. It's impossible. Right.
It's not like that's the thing. It's one of the reasons I'm had you on here so quickly is because this is such a common problem. And when you sit down with someone and you show them in bite-sized pieces how they can tackle this, and it's not impossible, all of a sudden just a huge relief comes over them that they can do this. So
well, and for me, I believe every deal is possible. Every scenario is possible. We can get everybody in a home, obviously, but you answer one of those separately, right? Okay, what's your biggest concern? This. Okay, well, here's a plan for that.
Right.
Right. I wrote off 2 months last year. Okay, well, you're about to file 18. Let's look at 18.
Right.
Right. And so there's always kind of an answer to go from there.
Yeah. And what every realtor should do, they don't all do it. What I definitely do is I get permission immediately to call my client's lender. And I become best friends with that lender because there's no deal without the money.
Yep.
So I call that lender and of course I get disclosure from the client that it's okay. And I don't share any of that information, but I've got to know everything that's going on. Sometimes I've got a family under contract and I find out a week before closing that, one of the conditions on the loan was they had to sell a piece of land. This actually happened. They had to sell a piece of land in another state. They had to close on a piece of land in another state in order to get approved for the loan that they were about to buy a house on in a week. And if I salvaged the deal, but if I hadn't gotten that communication from the lender, there was a lot of other things that would have happened that would have let it fall apart. So tell us, if you're representing a buyer and they come to me to buy a house, are you able to talk to me and share information with me to help it go smoothly throughout the whole entire transaction? Yeah,
absolutely. I mean, there's a gray area on what personal information, you're not going to give out any personal information, but, and especially with the client being okay with it, which they are, is any concern, we're all going to be on the same page. Right. Because they have to be. Because
we're a team, so we have to figure it out together.
Right.
Yeah.
Right. So you have not a lot. You'll run into some clients who want to keep each party separated. So, well, no, I'm already good. I already talked to a lender when they're talking to you, right?
Yeah. Or it happens all the time.
Or just send the pre-approval letter to me and then I'm going to send it to my realtor. They can do it any way they want. The problem with that is you have a breakdown in communication. So you don't know if there's issues with the loan.
Right.
I can't talk to you, so I can't tell you things you need to know before you make an offer. Right. Like how long for a closing date, how long for financing period, all these things that you would want to know. Yeah. But the vast majority of realtors and clients I work with, everybody's on the same page. Yeah. They're almost always on the same emails. Everybody's in the loop because it reduces stress.
Right. It doesn't happen like that all the time.
No.
Well, and I would think from a consumer standpoint, they feel some layer of protection if they keep the two parties separate. Like there's some type of leverage or they're going to have one up on somebody. But the reality is by allowing those parties to communicate, you're actually able to accomplish a lot more because of the
Right.
open lines
Absolutely.
of communication.
Right. You have to know going into it that if you pick the right lender and the right realtor, that they have your best interest at heart.
Right.
If you have any feeling that they don't, they only want
Yeah.
to check, they only care if I sell my home, if they only care about me because I'm getting paid off of their mortgage or whatever it is, you either already have concerns with those people,
Yeah.
you shouldn't be working with them,
Correct.
or you need to have faith that you pick the right people.
Yeah.
Yeah. Well, and I think that there are certain relationships between realtors and lenders where there might be some kind of under the table kickback or the consumer thinks that you're just being referred to because there's going to be some kind of financial gain for you
Right.
personally as a realtor. And I think that kind of goes back to having a quality realtor in the first
Well,
place.
yeah, for me, I'm real picky about who I refer. So a lot of people, I'm picky about referring anything.
Because it's a reflection on you at the end of the day.
It's a reflection on me, but more so, I truly am. I hold my fiduciary duty very, very close to my heart. So when I send someone to a lender, because it's a family, especially when there's children involved, and homeownership can be very emotional and it can be so meaningful to so many people. And when you send them to a lender who does, goes out and parties on Tuesday night and they're not answering their phone Wednesday morning because they're hungover, which is very common, I'm never going to refer that lender again. So I need somebody that works around the clock like I do and that has the same ethics and morals in their business as I do. And that's why I'm real picky about who I refer. And there's definitely realtors out there that say, okay, hey, they've got they have a relationship with somebody that's been in the business and they're sending each other referrals, but it's not necessarily because they hold them to such a high standard and can truly back them and vouch for them.
And it's not always in the best interest of the buyer or
Right.
seller.
Right.
Absolutely.
Well, and I'll go so far to add a story where not often, but I've run into some realtors where their preferred lender couldn't do the loan. Mm-hmm. And instead of being open to allowing me to do it or letting the client find somebody, they adamantly stuck to that story that the loan couldn't get done. And so in that point, your loyalty for the realtor was really based on that lender, not on the client.
Right.
And it was amazing for me to see, and you don't see it very often, but I've seen at least once or twice in the last 30 days where I was like, this makes no sense. Like you're not looking out for the,
Right.
You really don't, there's other things behind the scenes going on that maybe are more important than your loyalty to the client.
Exactly. Right. So what would you say if somebody is, say right now, someone's self-employed or they're a 1099 independent contractor and they're thinking about buying in the next year or two? What do they need to do? Is it where you can, I know every situation is different, but can you give a list? Okay, here's the next 3 things you need to do. Or is it best to meet with you, talk to you so you can get a feel for their situation and then tailor their checklist to that specific client?
Oh, absolutely. I think for me, anybody who's even remotely thinking about it, I want them to apply and us to work on it now.
Right.
I don't care if they're buying in 3 years. I've had self-employed clients where it took us over a year
Absolutely
to map it out and get them in a home.
And that's quick.
Yeah. For some, it may be 2 years or 3 years, or hey, as the business grows. The reason why is because once they apply, I have enough information to map it all out and give them a game plan and a timeline.
Right. That plan is so important.
Yeah.
So important. That's what I push everyone. Whenever someone wants to look at a house, I'm like, I'm happy to show you if you want to get a feel for where you want to go, but you're wasting your time if you have not gotten pre-approved, and make sure that you have that game plan in place. So.
Well, and I think what happens is because information is so readily available, they assume they're okay. And they assume that when they find the right house that they're going to get it. Well, the truth of the matter is if you're not pre-approved and you want to make an offer on a Saturday, Bank of America is not open.
Right.
So what are you going to do?
Yeah.
Right. And then all of a sudden now it's Monday, Tuesday, Wednesday, you're pre-approved. Well, depending on the market, that home sold Sunday night.
Yeah.
So they're really hindering them. They're thinking, I'm going to wait and not do anything until I find the right home. And that's
right.
actually the complete backwards way of doing it.
Yeah. The other issue with that is I have seen this several times where someone finds a house. They say, I already have a lender. they have the lender they want to use, but they have not gone through the pre-approval process. So they find the house they want. And nowadays, no seller or listing agent is even going to consider your offer if you don't have a pre-approval attached. However, I have seen lenders generate a pre-approval just immediately within a couple hours, and they haven't even vetted the client yet. So we've got a pre-approval letter. We're going under contract. They're putting earnest money down. Now they're starting the actual approval process, which is you looking at all of their documents and really getting into their income and all of that. And then they find out, never mind, we can't get financed. So that's why it's so important to be proactive, start ahead of time, and get a real pre-approval. So it used to be called the pre-qualification process, which was kind of the surface approval.
Right.
And then the lender would get a little bit deeper and get the true pre-approval. And now that pre-qual term is kind of gone.
Yeah, I mean, it should be. I don't do them.
Okay.
The pre-qual, you'll see some banks still do it. How much you make, how much your bills, okay, you'll be fine. Here's a pre-qualification letter. I don't do any of those. I don't even answer those questions, mainly because you need to know.
Right.
Apply. Let's look at exactly what your bills are, exactly what your income is, and give you a pre-approval letter.
And my big thing is, what is verifiable income? And that's a big deal, because some people say, oh, well, I get a check off of my property and the oil field property over here every month, or I get child support every month, or I get this, and they're factoring all of this in, and they don't really know what is going to count.
Right. Overtime, perfect example. Well, I worked a lot of overtime in June. I didn't really work any in July. Well, that's not really consistent overtime. So the underwriter could have an issue.
So that doesn't count.
But in your mind, not yours, but the client's mind, they're like, oh, I work an extra $3,000 a month in overtime. Well, you did 1 month, and then you didn't do the next, and then you did this. So, I mean, that's why you dig into it early on.
What are you laughing at?
Some people think that, if they work a lot of hours 1 month and not the next month, that they just get to consider it.
And my thing is
everybody rounds up. That everybody, how much you make? It's always 20%, 50% more.
Yeah.
Absolutely. Can you provide a basic outline of what income that you see typically from those type of streams, child support, other property incomes that you might have, or assets that were passed down? What are some of the 5 or 10 things that you can consider as additional income to your loan process, besides anything outside your typical true W-2 income or financials that you make from work?
Yeah, no, that's a good one. Let's talk about child support. So child support, you have to be truly receiving it. And what I say by that is, if the person gives a check 1 month, but then didn't the next month, that's not consistent. So if you are receiving child support and you do have those concerns, make it come through the state that you can easily document, or you show about a 3 month of them receiving it every month. Like, we had a client not too long ago. The dad will get the child for July or June, right? One of the summer months, but he doesn't pay child support when he has the child.
Okay.
Well, now you could have an issue because you don't have child support coming in.
Yeah. So just because it's on a court order doesn't mean it's going to be considered as income.
Yeah. Exactly.
Right.
Exactly.
So at the end of the day, you have to show the proof.
Right. Exactly.
And this brings me to another point I'm actually dealing with a client right now, is if you are, say, for instance, we'll use child support as an example. Let's say your ex is writing you a check for child support. You go cash it at their bank and take the cash. It's not leaving a documented paper trail to show that they're being paid on time every month.
That's a very good point.
Correct. Correct. So if you cash that check and you don't deposit it, we have no history of that. I'll go further to say, too, if it's one of those where I owe $1,000 a month in child support, but they needed braces, so I gave you $300 and I only wrote a check for $700.
Right. Now there's an inconsistency with the monthly income of the child.
The story's not holding up. So if you're dealing with child support, right, and you're a mom, let's say, and you're receiving it and you need that to qualify, stick to the guidelines, stick to the rules of the child support decree.
Right.
That says, hey, you owe me $1,000 a month. Give me $1,000 a month.
You guys need to see that $1,000 hit the account every single month, and then they can use it as income to purchase.
Right.
Okay.
Yep.
Yeah.
Other forms of income, you can be a W-2 employee, okay, let's say you have a regular job and you have a side hustle and you report down your tax returns, you can use that income. Okay, so you have to have a 2-year history of that. So let's say you work a regular job, you do Uber or Lyft, and you've been doing it for 2 years and you report that income on your tax returns. Fine.
Got it.
Perfect.
So it's 2 years. I kind of feel like that's the magic number. If somebody's self-employed and they want to buy a house, it's typically about 2 years out is how they're going to really position themselves strongly so that everything goes well.
Right. And 2 years tax returns is really how you want to look.
Okay.
I have filed good self-employed income for 2 years. If you started halfway through 16,
okay,
you filed 16 tax returns but no income or less income, then you filed 17 and then you're halfway through 18. My math is off a little bit. That doesn't work. What you want is 2 full years of tax returns for the most part to be able to then average it and use that income.
Okay. Got it.
And then if you don't have 2 years of tax returns because your accountant slipped up or you wanted to write everything off because you didn't think you were going to be buying a house. So 17 is a shitty income year, 18 is good, and all you have is 18. That's when you might look at other opportunities like the bank statement loan, or are there other 1 year kind of loans that people
Is there
could look
hope
into?
for anybody that doesn't have a full 2 years of tax returns, or is that what they need to do?
That's really the short answer. Now, going back to if the income is crappy in 17 and great in 18, one is if you average the 2 years, does the income work?
Okay.
Right? And income working from the standpoint of it may not be how much you're reporting. Does it work enough to get you approved? If it works enough to get you approved, let's get you in the house, right?
Right. And that can flex depending on down payment and all of that, right?
Right, exactly. Loan type.
Yeah.
If it goes conventional, it may be easier to qualify than if it goes FHA versus conventional. I mean, there's a lot of ways you can kind of put it in there. In general, one additional thing is if you've owned the business for 5 years, you're doing a conventional loan, normally with 20% down payment, they'll allow you to use 1 year tax returns versus 2.
Got it. Okay.
So in that example, you would throw out 17 and you would use 18.
Got it. And what qualifies someone as owning the business? Is it filed as an LLC? Is it a DBA they're operating under? What would consider...
Right. Any of those things that show the documentation. The first thing we're going to do is probably Google the business and see what shows up as public records.
Okay.
If it was filed, if it is an LLC, it just kind of depends. That 5 year thing is a little bit harder because, I mean, you're going back 5 years versus 2 years of tax returns. You have 2 years of tax returns. You have them, you're recent. Good.
Yeah.
But one thing too for self-employed is don't overlook it. If you're listening to this right now and you're thinking that some of these things tell you yes or tell you no, don't assume.
Right.
Right. Because certain people, they'll listen into it and say, hey, I can't do it because he said if the income goes down, it could be a problem. Or if the income went up, that could be a problem. Don't overthink it.
Right.
Right. The whole point that you and I were hoping by sitting down is going over everything we could think of that somebody self-employed would run into to give them the nods to feel comfortable to really reach out and ask more questions.
Right. Yeah. That was my goal for this, is not only to offer kind of in a way some comfort to my clients that are self-employed, but being self-employed myself, or my husband being self-employed from the 15 years we've been together, this is something that we have dealt with often. And I mean, especially being in the industry and dealing with lenders in the real estate industry, I've been told a million different things myself. So to get clarity on it is super important. And then to have a game plan put together. I love when someone comes to me and says, all right, this is what we're working with. Figure out how we can put the puzzle together.
Yep.
And you do business the same way. So that's why we make a good team. But that's what, if you are self-employed and you're thinking about if you can or can't buy a house, or if you'd like to buy a home in the near future in a year or two, you need to start putting the plan in action now.
Absolutely.
Right. Well, I want to thank Dave for coming on the show, and keep tuning in. Next week, we're going to be talking about VA loans, and if you're a vet, how to get approved for that and all of the new qualifications for that. It's really exciting. So, this is Laura with Level Up with Living Houston, and thanks for tuning in.